morning to everybody here, and I understand maybe as many as 250 online. So, good morning. I just came from another meeting, but I'm not sure if you've heard, but online in the Star Tribune, they mentioned that to eat in Minneapolis and St. Paul, you're going to have to mask up and show your most recent test or your vaccine card. So plan on that starting here on the 19th. Okay, so I'm Dave Rasmussen of Grandbridge Real Estate Capital. Roughly, we did about $10 billion last year nationally out of 23 offices. Minneapolis office did $1 billion. So we had a very successful year. And when we talk about capital, it involves some math. And I think about math a lot. And if anybody here knows me, they know I keep a lot of spreadsheets. So for example, I don't know if anybody else has heard about this gas app where you can save 25 cents a gallon. And that ad goes on and she says at the end of it, you know, she saves $200 a month. And I'm thinking, boy, that's interesting. That's cocktail money. I better sit and figure this out. So 25 cents, she needs to buy 800 gallons of gas. If she averages 20 miles a gallon, she's driving 16,000 miles a month. So as you think about the math, and we're going to talk about that today, we're not going to go too deep into it, but it does affect the capital markets. So what we're going to do today is we're going to run down the list here. I'll let people introduce themselves, and we're going to talk a little bit about the impact of inflation. Marsha, you want to start, and then we'll rotate around.
Sure, sounds good. So I'm Marsha Goff with Merchants Capital. We are a subsidiary of Merchants Bank of Indiana. We focus primarily on affordable housing and then also what we call workforce housing. And we provide all banking products, construction loan, bridge loan, letter of credits, all to facilitate the financing needs of developers and owners. And then we also do the perm financing with Fannie Mae, Freddie Mac, and HUD, as well as obviously our private placement. So we have offices throughout the country, and we also have had a record year. So I'm very happy to be on this panel, and I look forward to meeting more of you here in the Twin Cities.
Right. My name is Peter Evans. While I am on the investment sales side, have been for the last 16, 17 years. I started my career at Freddie Mac with Rich Martinez, worked with Marsha at Glacier Financial, worked with Ed Padilla at Northmarq Capital as well. So I have a mortgage banking background. I'm a senior managing director at Berkadia. We've done about $40 billion in loan business this year and $27 billion in investment sales.
I am Mike Padilla with Northmarq. I am not Ed. Ed is now retired wisely. Although we too had a record year last year. I think we ended up somewhere on our company-wide at around 34 billion. And that includes our investment sales platform and debt. We have about 42 offices around the country. We're family owned by the poll ads here locally. So we have all the particular debt platforms, Freddie Mac, Fannie Mae, HUD, as well as life insurance company and CMBS.
I'm Lucas Goring. I'm at Bellwether. We've got 30 some offices across country. Last year, company did about 13 billion. We did about $1 billion out of Minneapolis. Fannie, Freddie, HUD, lots of life company stuff, and similar to the Northmarq and Grandbridge platforms.
And Nick?
Yeah, I can. Good morning. I can bring us home here. Nick Place with Bridgewater Bank. I'm our chief lending officer here. We are locally founded, locally focused community bank in the Twin Cities, right around $3.5 billion in assets. Multifamily is our largest single asset class. And around 95% of our portfolio is Minnesota-based lending. So we really focus on Class B, Class C apartments, a good amount of new construction, and fairly active in the affordable housing space as well. Happy to be here. Sorry, couldn't be in person.
That's good. We were able to work it out and have you on. let's just talk about inflation and what does that mean for owners and developers? And
Sure. Yeah, no, happy to take it. I think right now what we're seeing is a tremendous amount of inflationary pressure on, well, throughout the economy, but certainly on housing costs. And one of the reasons, one of the themes that we've all been talking about is supply and demand. And if you all wouldn't mind, could you pop up that one chart that I gave you? The IT guys? Thanks. So, everybody's talking about supply and demand and an undersupply, but, rarely do people actually start putting, pen to paper and really talking about it. If you could blow up the chart, there, if you could blow that one up. The reason that we have an undersupply of housing is that over the last decade, we have delivered far fewer households to the market than we had the prior 2 decades. And so that's and then the top part of the slide there is job growth. So over the past decade, we have experienced record job growth. So you have these diverging chart patterns. So you have if you believe that job growth leads to household formation, then we have more demand for household formation than ever. And clearly we are delivering far fewer. If you pull down just a little bit, pull down just a little bit. Pull down just a little bit more. So that's our job growth chart. Pull down just a little bit more if you can. But anyway, you will see that that over the last decade, we have delivered far fewer units. And so that is what is leading to the imbalance between supply and demand. So when people are talking about, rent inflation and saying that they're so surprised at how strong it is, my comment has been, hey, I'm surprised that it took this long because we have been in a very long-term trend of undersupply. It did take COVID to push those inflationary pressures even higher. So, with construction costs where they're at, I don't see the ability to deliver enough housing units to satisfy demand for household formation. So I think that we're going to see a long-term inflationary trends continue in housing costs.
anybody else have comments on
Well,
inflation?
yeah, I want to get back to kind of comment that you made, math is math. And so obviously from a financing perspective, for existing properties, we look at, heavy emphasis on the trailing 12. And so then obviously you have your NOI, and as expenses go up, that's going to impact your underwritten NOI, which obviously if that's lower, then if you're debt service constrained, you're going to have the constraints of a lower loan amount. We're seeing those pressures right now. Even in the past, month, the 10-year treasury has increased 20, 30 basis points. And that has a significant impact on the loan dollars that you could see. So definitely we're seeing that. As my partner Joe says, math is math. And, there's certain things that you can and cannot do. And I can tell you from a GSE perspective and a perm underwriting perspective, they just came out with some additional guidance on the exit analysis, because we're always looking at what the exit analysis is. And sometimes it's amazing because the exit analysis can be the limiting factor for the maximum loan amount. And so you're gonna look at, well, what's the interest rate in, let's say you have a 10-year loan, what's the interest rate spread that you're gonna put on, and then what type of cap rate do you use? And then we just saw guidance from one of the GSEs that they're definitely taking a look at the income growth, and they're looking at it by market. So while you may say you're going to have a 5% income growth, they're possibly going to cap that for your exit analysis and also going forward. And obviously we have to underwrite in place rents. And then we take a look at what's going on with the expenses, but heavy emphasis on the T12 for the GSEs. HUD, not as heavy of an emphasis. But again, when you start taking a look at it, when you take a look at the interest rate possibly going up, expenses going up because of inflation, you could look up with a slightly lower NOI, and then we have to stress it accordingly for the exit. So I think that, that is something to keep in mind. Sometimes people, you don't think, and when we're quoting deals, we will take a look at quick run at a detailed exit analysis, because sometimes that is a limiting factor. You can get waivers, but it's, sometimes it's easy, sometimes it's not. Yeah.
Our old refi test.
Yes, I know. It's like, darn, this is back again.
Lucas?
Yeah, I think one thing we've heard a lot today is these cap rates are way down in Nashville at 3.25, and here and hitting 4. The effect of that on the debt side with the agencies is a full loan in their model at the 125 debt cover is going to be a 55-ish% LTV. But there's still a lot of people chasing that sort of stuff. To Timberland's example, where they put the call out for needing 18 million and had it filled in an hour and a half. People are still investing in this stuff. Nick and I are working on a deal right now, and the borrower was raising some money for an acquisition, and they told me they've oversubscribed and have had to have some tough phone calls with people they've invested with before that we just don't need you right now. I think there's a lot of money sitting out on the sideline that aren't typically real estate investors, but have watched real estate go up and up, and it's the sexy investment strategy right now.
Well, inflationary risk for us on the debt side. I mean, I guess on the GSEs and with life companies as well, they have an allocation they need to get out. You know, on the life company side, they're selective on leverage. Some of you have maybe tried to do that. It's typically going to be at a certain level, and they're going to put some sort of credit matrix on it, whether it's a refinance test of some amount at a certain point in time or a debt yield or something like that. So, but there's still, you know, so much money that wants to get out, and they're going to be aggressive in trying to get those deals done. So you'll see treasury increases here, and then if money is not getting out, we will hopefully now see some spread compression, and that starts to drop a little bit to make deals work a little bit better, but we'll see how that goes.
Well, and I think we're seeing it right now, real time. We are seeing, spread compression. I don't want to date myself, but in the mid 90s, when I was at Freddie, if I had 130 basis point spread, that was a big one, right? I mean, we were doing deals at, 80, the low 80 spreads. And so, it certainly has been, a tremendous run on ROI for lenders being able to have a spread that, matches your index. So I do think that there is a lot of room for spread compression. And as everybody is saying, there's a tremendous amount of money that is built up, for deployment of capital, into the lending arena. Last year, we did of the $40 billion, half of that was with GSE business. So half of that was other types of business. And a lion's share of that was the debt funds. So you have, these additional capital flows that are coming into the market that are going to, push Freddie, Fannie, to be more competitive. I think.
Yeah, I would agree with that too, because one of the best things you can do for Fannie and Freddie is tell them where the competition is at. Because if you tell them where the competition is at on a specific deal, they'll come in and tighten their spreads. We have to go in for certain waivers. They have grid pricing. But again, the investor demand is very high right now. I remember, in apartments, there was the low totem pole of the asset class. Now we're, we're right up there with industrial. So again, there is a lot of investor demand. And, sometimes we work direct with the investors. Sometimes we take it out to a bid process. And a lot of times we're definitely oversubscribed. So the continued, while treasuries may go up, I think the investor spreads possibly could come down because of the deployment of so much capital out there specific for multifamily.
How about you personally and the bank views on inflation and how it might impact your business?
Yeah, I think the inflationary pressures are real. I think we're seeing it across the economy. Multifamily has certainly been a good performing asset in inflationary environments, which is why I think it continues to be a preferred investment vehicle for a lot of folks, given how short-term leases tend to be. But The follow-on issue of that is the rate side of things. I mean, inflationary pressures will cause the Fed to react, and we're already seeing that now. I mean, the Fed's given guidance that they're guiding for 4 rate hikes through this year. Jamie Dimon, he's taken the over on that. So I think that will certainly drive. Matt was talking about lumber pricing on on new development projects. A lot of those construction transactions are floating rate deals. Construction period interest, that we're stressing those when we're looking at transactions now to say, how high can these rates get and how much construction period interest do we really need to be building into these transactions? So, and then who knows what's going to happen in the 5 to 10 year part of the curve. Do rates overall flatten, or do we continue to see some steepness in the curve driving the 5 to 10 year part of the curve up? So that's the who knows side of things. I'm not an interest rate predictor by any stretch of the imagination, but inflation will drive changes to interest rate scenarios, certainly. So it'll be interesting to see how that plays out too.
I would agree. I saw from the supply chain side of the business this last summer, where we had some apartment deals and the lumber just got crazy, that they postponed and eventually canceled a couple of transactions. And then labor shortage, and this adds and fuels price increases. The rents in some cases haven't caught up to cover these expanded costs. So we've seen some projects delayed from that perspective as well. And then my view, and I think globally, I think 22, we're going to see higher rates. We're seeing the treasuries climbing. And as we talked about spreads, I think once we bump into that, we're probably right around 4% right now for agency debt. But if we start bumping up around 4.5 with life companies and whatever, their phone's going to stop, and people are going to try and find alternatives, or they're going to go to a shorter term to try and pick up a better rate. And so they'll squeeze their spread over that rising treasury to try and keep it, because they don't want to get it out of hand, because they want to get paid their bonuses too by the end of the next year. So let's talk a little bit. I know this has probably been mentioned in some other segments, but let's just talk about rent controls, the threat of and the actual implementation in the various big metro cities here. And what do you think that's happening to our capital markets, and how are you hearing from the sources at your rep?
Well, like I said, I focus primarily on affordable housing and or workforce housing. So honestly, the rent control has not had that big of an impact with those equity providers. They underwrite to a 3% increase generally. So from that perspective, and from the workforce housing perspective, unless you're looking to reposition the property, it hasn't had any impact on really any of the demand for the equity pricing, or also on the debt side. And again, on the debt side, when we underwrite, we have been, before they used to limit the rent growth, again, not just for affordable housing, but the standard was 2% a year for income, 3% for expenses. So from the rent control perspective, it really hasn't impacted the underwriting per se. And again, from the affordable housing perspective, as well as the naturally occurring, class B and C, we have not seen any impact on that. Now, again, it might be too soon to say, but we haven't seen it. So
I would agree as well. We haven't really seen it as much yet. There's been questions to us about how we see the impact happening, not so much from the Freddies and Fannies of the world, but more from the life company side. And I think that the way we underwrite on the agency side, and even with life company too, we can't use future income in our calculations. So it's on historical income or actual. So it hasn't had much of an impact yet, but the question does come up, and we'll see how that goes.
Maybe I'll be a little contrarian. I'm seeing, significant capital contraction in areas where there is concern for rent control. The reason that I'd like to show that one chart is it's so profound, and everybody in this room understands the need for additional supply. And so thank everybody in this room for, for contributing to that, because it is vital to our society. But when you have rent control measures in place, it will further exacerbate the undersupply of housing units, and it will further increase the pressure on, on rents. And, for the folks that are, in the government, understand that, encouraging supply is vital, that the people in this room want to develop more apartment communities. They want to improve the living conditions of the residents. And if you allow us to do that, that will effectuate, a moderation in rents. If you try rent control, it's just going to do the exact opposite. And those things matter to investors. So I see capital contraction on the face of it.
I would agree with, Pete as well. We should, I should note that I think you are going to see an impact on value add deals and on investor return requirements, and they're just not going to get it with that kind of a return. So they're going to back out, and it's been happening somewhat, but I'm, curious to see how the impact on value add will be, especially in St. Paul.
Yeah, I agree with you guys both on that, because I think the equity investors, again, it doesn't impact LIHTC equity investors. That's a different kind of, that's different, product type, and they've already built in that 3%. But market rate equity investors definitely are looking for a higher yield. And when they see that income growth is limited, then they're going to pull out. Or
right on the debt side too.
Exactly.
I'm hearing, lenders that are just, have pulled back from Minneapolis St. Paul, proper, certainly very, very interested in the suburbs. But when there is an event like this that that changes things so dramatically, inherently you're going to have all investors just hit the proverbial pause button and figure out what this really means.
Yeah,
Until,
what does it mean?
if you don't have clarity, it's hard to attract capital.
I'd chime in real quick too. I think we're absolutely seeing it as well. I think rent control just creates yet another risk for a bank to underwrite. Generally, we're trying to mitigate risks on every deal. So this is just yet one more thing to think about. We do a lot in the new construction and repositioning type transactions. So, Lucas, the transaction we're working on, I don't know the number off the top of my head, but they are certainly projecting more than a 3% lift in rents on that reposition transaction. That is not in Minneapolis or St. Paul. And we won't avoid those areas, but it's yet another risk that we need to think about. So we need to figure out ways to mitigate that. And that's either, additional reserves or additional equity requirements or larger sponsor guarantees. We are all about trying to look at what those risks are and figuring out how we're going to mitigate it. And to put, some real specific dollar context to this, I pulled up some numbers here this morning. Of our in-process construction projects, 56% of the dollar amounts are in Minneapolis or St. Paul. From January 1st to today, or Tuesday, our last pre-flight meeting, we had 10 construction projects come through our pre-flight review process. One of them was in Minneapolis. Wow. So, if that doesn't tell you the shift of what our borrowers are looking to do, regardless of what I'm comfortable doing, I can only do what my clients bring us to look at, and our clients are showing us that they are looking at investing their dollars and their capital, in other parts of the Twin Cities. So, it is certainly having an impact on how our clients are looking at deals, and ultimately, we respond to what our clients are doing too. So we can only lend where we have opportunities to lend.
I would echo pretty much what everybody else is saying, that the GSEs being backwards looking aren't too concerned about the rent control. Life companies, it's going to be a more conservative loan anyways. So the exit tests are they can meet those pretty easily. I had one transaction that the lender, it was a debt fund lender was very interested in the transaction before November. And this was in Minneapolis. And then after the rent control, they've taken a pause from lending in Minneapolis and St. Paul for a little while. And it's more of the national lenders that are looking at our market, not the local. Nationally, Minneapolis has just taken a beating in the press, I guess, in the last 2 years.
I'd agree. I agree.
Yeah, I would agree too.
We've run into deals that have been on hold or canceled in St. Paul. Minneapolis has us hanging over their head with no sign, without any set rules in place, and that's almost as bad because it's the fear of the unknown. And last year, we had an equity transaction that we were bringing in, kind of a joint venture partner for a development. And the guy was out of Chicago, and all he wanted to talk about were the riots. And so he ended up passing, but I tried to explain that the location of that activity was different than this western suburb. And but they kind of blanketed the whole Twin Cities market. I wanted to ask him about Chicago, but I couldn't go down that road, I couldn't cast any stones back, but
Dave, that's similar to if you're pitching a deal up in Fargo and
Yeah.
the lenders are asking you what the oil impact is on that.
exactly, yeah, even though it's at the other end of the
Yes.
of the state, yeah. So I think the Twin Cities is building a national reputation that is harming our real estate markets. And so we need to be careful how these storylines play out. And so we just need to listen and help where we can in our industry to help explain to people on a national basis that some of the locations and things that are happening does not impact the entire real estate market of Minnesota that we all play in. Okay. Let's talk a little bit about Fannie, Freddie, and HUD updates. Anything that's coming down the pipe, things we should be worried about, how a loan in 22 might look different than they did in 20 or 21. Any comments there?
Affordability, which is good. The GSEs are going to be more focused on mission rich loans. So, that CB sector, is going to play into things. So I think that's a positive shift. They have, full allocations again this year. And they're going to have to place a lot of money. So
Yeah, because their
and
volume.
Ginny spreads are.
Yeah, their
Ginny.
volume, Ginny, yeah.
I mean,
Their volume caps for the GSEs, they came out, I don't know, October, November, and they're increased slightly. They have volume caps for what they need to do also for affordable housing, as well as, their definition of affordable housing, as well as now they're really starting to hone in on what workforce housing. There continues to be a question, what exactly is workforce housing? What's that range? But we have seen, we saw, Freddie pull back from their non-LIHTC workforce housing forward program. Now we're starting to see them actually open that up again. So that's really nice. We actually did 3 loans and they leased up like that. And those were all like around 80% AMI. So we're hearing that, Freddie's opening that back up. Their FHFA regulator is looking at those products. And then Fannie, they don't have a published workforce housing program, but they said bring in the deals and we've been talking to them as well. So again, I think you're going to continue to see affordability in the BC product. And then also, I think it was just yesterday, they came out with, just Fannie, the regulators want to do more 5 to 50. 5 units to 50 units loan size. And they also are going to give pricing discounts off of conventional pricing for the 5 to 50 units. So again, that combined with the affordability and the workforce initiative, the workforce housing initiative, I just think you're going to see more emphasis on, and probably slightly better pricing on affordable and workforce housing.
So your 200 unit deal just became phase 1, phase 2, and phase 3.
Right.
Yeah, I would agree. You would see typically, because the push is so hard for what they call mission-based or affordable, and it can have, a property can have a restriction on it in some way for the affordability, or it can be affordable in a natural way as well, where it's a percentage of AMI, and you'll probably see a 25 to 30 basis point improvement in your interest rate if that calculation comes into play.
Fannie also, I mean, we haven't done any of these and it's really was meant for more market rate housing, but they have that program called SIA, Sponsor Initiative Affordability Restrictions. And they're going to do some more training on it, but that's a lot of times to qualify for affordable, you had to be Section 8 LIHTC or have some sort of regulatory agreement on it.
Mhm.
Now they're finally accepting that if a sponsor wants to put a imposed regulatory restriction on the property for the life of the loan, that then will qualify for this lower
Right.
housing. And that's relatively new program. I think they did roll it out earlier last year, but I hadn't seen a lot of traction on it, but we're starting to see, and they're starting to push that more. So
We did a transaction last year with that.
did you?
with-
Yeah.
With that, and I think it was 20% of the units had to be set aside at, was it 80% AMI?
Probably.
And it was a very easy, the
It's just-
property we were working on, it was a no-brainer. And I think it got them 20 or 30 basis points off.
Right.
There's some annual reporting that goes along with it. But it's just a restriction on the loan that you're going to keep certain units affordable.
Right. Isn't it, if you pay off the loan, then that restriction goes away?
Yes.
So it's not like in
It's not on the
perpetuity.
deed.
Right. So it is it's an initiative that I think, again, this is coming from FHFA and the regulators. So I think you'll continue to see more.
The one we did was very early when they did it, so it wasn't clear what the consequences were if you didn't follow through with it. That you may just have to pay back the interest rate savings. So to the borrower, it was
Right.
easy for them.
Nick, let's talk about construction lending and the bank's views on construction lending, and what do you see coming down for 2022?
Well, I alluded to this a bit earlier. I mean, we're only 13 days into the year. We've seen 10 different construction deals come across our desk just this year, and it's sort of just the season for that. I mean, this is generally when developers are, actively getting their deals put together for breaking ground in the spring. So not super surprising with that, but we continue to see a lot of demand. We talked about a shift of location. We continue to see a lot of our transactions be more suburban driven versus, pre-COVID, most everything was, urban core driven. I mentioned the rising or the expectation of the rising rates in the short end of the curve. We are keeping a close eye on and stress testing our construction interest reserves to make sure that we've got ample balances there. Also, if we are not providing a mini perm option on the construction loan, meaning that once you're up and stabilized, that either the rate's fixed through construction to some period of time, or that there's a fixed option once you're up and leased. We're generally sizing to a debt constant that's higher than what the initial note rate is for the construction period interest. So, I think a lot of borrowers are thinking about, borrowing on a short-term variable basis, in the low threes, and thinking that that's what your terminal interest rate's going to be. And that's certainly not what we're stressing and sizing to. So, and we continue to see values are strong on transactions. The prior, I love when the brokers talk about all that capital out there. So if I go back to a client and have to size their deal down a bit, I just remind them of all the capital that's available. But I don't see those values translating to super strong debt service coverage ratios. Debt yields are grinding lower and lower on every deal that we see, it seems. So I understand construction or interest rates spreads can tighten, but as costs to build increase and the expectation of terminal interest rates change, there's it gets pretty difficult to swallow a debt yield that's 6%, right? I mean, it gets really hard for us to make that pencil out. And we get a lot of clients that come back and say, well, the loan to value is really low. It's like, well, that's fantastic, but I'm relying on the cash flow to repay my debt. And ultimately, if I'm not providing, mini permanent financing, I really have to stress to an interest rate environment that could be significantly higher than the interest rate environment that we're in today. So we continue to see a lot of demand, though. I mean, for all the macroeconomic reasons that we've talked about from a housing constraint perspective, single family home prices are through the roof, through the moon. So, that's becoming more and more unaffordable for folks, which is driving people to look at some of these new multifamily products. And whether that's your traditional, stick frame building to the rental townhouses and rental single family home options that have been built in market across the country. I mean, those are becoming more attractive too. So, and I think that shift will continue, frankly. I think as folks push and developers look to suburban spaces where land is more abundant and a bit cheaper, that townhome, single family home rental product is being absorbed very well. And I think that that's a trend that we'll continue to see expand here in the market, over the next 3 to 5 years.
Okay. I'll just mention 2 transactions that I think many would like to think about as you're looking forward, and if you think interest rates are going to go higher over the near term here. One was a 150 unit apartment deal that we did. And what we did is we did a 2.5-year construction loan mini perm so that he could draw down the funds and get the property built. But then we tacked on a forward swap. So what we did at closing is we locked 2.5 years forward, so 30 months. He'll roll into a 8.5-year or an 8-year forward swap, and he locked his rate at 3.20. So he knows as he's building out this project that 3.20 rate is sitting there for an fixed 8-year period, and he can sleep at night. And because interest rates have crept up already, that swap is in the money. So in the event he wanted to unwind it and say that property's created some additional value, he could unwind that swap, get paid instead of making a prepayment penalty, and turn around and take out a Fannie, a Freddie, a HUD, or something else down the road, life insurance company, or sell it and not incur that prepayment penalty. But yet he's got that safety net of that forward swap. Another deal that we just did was when you're going into Wisconsin, the first intersection will be Carmichael and 94. So it'd be the northeast corner. There's a 160,000 medical office building that's going up. That was a $40 million construction perm loan there. And what the doctors wanted was that they wanted to get it built and opened in 18 months. And again, they wanted to eliminate their interest rate risk. And so we put in that 18. So in June of 2023, they have a 3.55 rate waiting for them because we did this forward swap. And we were able to lock in that rate at closing and eliminate that interest rate risk. And what's the interesting thing that I've learned about working with banks is that they have different profit divisions. So the loan officer that you're dealing with, he's got his deal and he's got to go to committee and get the deals approved, and he's got his book of business and everything else. Then there's that trading desk that actually handles the swap. And I don't know if the two actually talk to each other, but we've been able to take some of the rate that's been baked into these deals, because you've got your index, credit charge, and then the spread. And so by negotiating these, we've been able to save our clients over $1 million on both those deals in interest rates. On the medical office building, every basis point was worth $29,000 of interest. So it's amazing what you learn in this business, and it's been a really fun journey. Typically in our business, we quote the 10-year fixed rate loan and, lock it up and close it in 60, 90 days. These take a little more energy, but they're fun. And I think I'm helping some guys sleep at night, knowing that they've got these rates parked out there 2 and 3 years from now. Yeah. We've got just a wrap up here. He's already walking up to give us the hook.
Yeah, 5 minutes.
All right, give us 5. So maybe you could touch a little bit on any topic that you'd like to. Debt funds, other lending solutions, what you see for 2020. If you want to procrastinate and come back a year from now and say, I was right, interest rates were this, and that's what I called. So whatever you want, however you'd like to finish.
I can speak to the debt fund side, which is typically like a bridge loan from an institutional investor. And This is company-wide for us. I think in 2020, we were somewhere around 800 million in debt fund or bridge loan business. And last year we did 5.7 billion of debt fund business. And we really saw that jump. And I'm, interested to see how that continues on with market and see where that goes. I don't know what you guys have.
Yeah, no, I think the debt funds and life insurance companies are going to continue to add a lot of liquidity to the market. So, the good news on the apartment side is there's liquidity from all sides. One of the interesting things, and we're seeing a little less of it, obviously, with the tick up in interest rates, but to see everything green lighted with lenders. I'm seeing lender risk appetite, as high as I've ever, seen it in the 33 years that I've been doing this. We're seeing, treasuries and interest rates relatively tame in the face of, very, very strong inflationary pressures. We typically don't see that. We see spreads that, again, are very, very tight. And then you have lenders that, while yes, they are looking, at trailing, we are seeing them tighten, that look back up because they are trying to get more aggressive in their underwriting. So, you kind of have the best of all worlds right now. Usually one of the things that I just discussed isn't going right for one reason or another. So I would expect the debt markets to continue to be to be pretty liquid this year.
Yeah, I would agree with you on that. I think too, because of the resiliency of the apartment market, the multifamily
I
market.
love it. Yeah, you're right.
Because when COVID hit, everybody was concerned about, foreclosure and, notice for, all of that stuff. And it really never happened I know for our portfolio, it was all clean. There was no issues. And so I think they've realized that this is such a good asset class that it continues to carry forward.
It's such an amazing point, Marsha. People talk about the Southeast, they talk about these other markets. Our area median income is almost $100,000 here. The percentage of income that goes to housing is 20% in the Twin Cities. I mean, the durability of our income here is spectacular. And then people are, you got 20-30%, rent increases, down in Florida. Your area median income is 30% less, and you think that those people are going to be able to continue to absorb these astronomical, rent increases. I see Minnesota as the best risk-adjusted market in the country to invest in right now. And I think that while yes, our average rent growth has been less than the national, the one prediction I will make is that we will not be bottom of the pack in 2022. I think we're going to see a significant turnaround, in rent growth in the Twin Cities. And we have the capacity to absorb it much better than many of these other areas around the country.
Last comments down there? Anybody?
I agree. Everything's great. We'll be fine.
Nick?
I'll chime in real quick at the end too. I think I think this panel next year, I'm optimistic that we'll have a lot more clarity around rent control within the Twin Cities. And I agree with one of the prior panels on I think St. Paul's program or policy or stance on it will shift. So I'm optimistic that that'll result in some readjustment of capital flows back into those markets. And I think we'll be thinking and talking about Minneapolis and St. Paul a bit different next year. But I continue to keep a watchful eye on rates and the yield curve in general, because the brokers were talking about how much they felt the market could absorb before it would impact values. They mentioned 50 basis points. And Marsha mentioned, I think the 10 years up 30 some basis points since December 1st. So, you're 60% of the way to your 50 basis points already. So I don't know how much that'll impact value or when or how or if, but it certainly will to some extent at some point. So I think that's another trend just to keep an eye on this year.
And I'll finish with just commenting about one more structure, another solution for a client. In that we did the first phase of student housing at Michigan State University, and then he built it says $19 million loan. kind of a 65% loan to value. And now the second phase, we put another 10 million on. So now we're up to 29 and we're still in that 65%. He's considering selling it and he's doing the math and he's going, geez, I don't want to pay those capital gains. What else can I do? So we're bringing in a piece of mezz or pref equity to slide in behind it for another 10 million because he's got a bunch of deals in his pipe. You know, I don't suppose anybody else has this issue. He's rich in deals and short on cash. And so he'd like to figure out how to do these other deals, maybe without bringing in other partners and giving up the upside on these other deals. And so this slice of capital, while it's a 10.5% cost, you go, ooh, it's cheaper than a partner, but a little more expensive than debt. And when you blend it with your debt, this debt's 380, you know, his all-in cost is 5% on his total capital stack. And now he's got dry powder and he can go do these other deals and it's not a taxable event. So as you're thinking about strategies for your clients or for yourself, there's a lot of different ways to slice and dice. There's a lot of capital sources out there, whether it's debt funds, just straight up life insurance companies, agencies, that sort of thing. And we'll all be glad to help you. And it'll be interesting to see what happens here with rates and cap rates as we go forward. Thank you for your time.
Thank you.
Thank you all.
Thank you.